Welcome to Quiver Financial's weekly financial market update, where we discuss the news topics that matter most to your investment portfolio and update our clients on the changes we're making in their portfolio as markets evolve throughout 2025. Well, welcome to Quiver Financial's weekly market update, where we talk about the news that matters most to your investment portfolio and update our clients on the changes that we're making in their portfolios as markets evolve in 2025. We had a little break last week. I was in Texas, got to go to the Waco Surf Pool, which was a great time. Spent a few days with Justin Singletary at the Texas Dental Association's big conference that they do every year. We got a booth. We got to talk to all kinds of dentists about why they need to have 401ks and how to maximize their retirement plan, blah, 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 blah. So now we're back in action this week. And boy, not much happened while we were gone, but some important stuff did. And I'm seeing some things in the markets that are making me go, So let's get into that and see how and what matters to you right now. So this week, we started the week with another Trump bump tariff news. So we ended last week with, okay, Besant and everybody's going to China to get the deal done. And we ended on Sunday and opened up on Monday with a pop higher in the market because they came out and said, we got a 90-day pause. Well, boy, we're going to kick that can down the road. However, in that 90-day pause, the tariffs with China dropped from 145%, which is basically an embargo, down to 30%. And this is on top of previous tariffs. So they're still substantial. So there's still an effect in the market. But we had a relief rally. When we get into the stock section of today's conversation, I'm going to show you the levels I'm watching now that we've gotten above resistance, something I showed you guys a few weeks ago. And more importantly, I'm going to show you what sectors of the market continue to be the strongest within all this volatility. Another big piece of news that I think is relevant to your portfolio this week is Trump and the UAE. So Trump and Saudi, and I know a lot of people are seeing this in the news and probably thinking to themselves, oh my gosh, Trump is making friends with the Saudis and blah, 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 blah. This is the Republicans, okay? This is not just Trump. What you have to remember is that the current Saudi Arabia, in the way that it's set up right now, the current prince got his control in 2016. And just go back and look at the history of when Khashoggi was killed, how he got into control. At the end of the day, it was a coup. It was funded by Carlyle Group, who manages money for the Bush and Cheney family. And then also you have BlackRock and some of the usual suspects. Basically, in 2016, the prince cut a deal with the West that if he would open up Saudi markets to the West, also transition away from oil, which is what he wanted to do anyway. And if you notice, since 2016, Saudi Arabia, Dubai, all these places have really transitioned away from oil into all kinds of a business. And that's also when the Saudi Aramco fund, so the sovereign fund of Saudi, rebranded itself to the private investment fund. And now you'd never know that that was the Saudi fund. So what you're seeing in the news this week with the deals with Saudi have been going on for quite some time. And so that, what that matters to you is, we'll talk about it in the stock section. One of the leading sectors this week, or one of the leading sectors this year in the market, continues to lead with some of this news. And I'm going to show you in the charts some of the opportunities that might be there for you. Quiver Financial's weekly market report. Well, welcome to Quiver Financial's weekly market report for May 16th, folks. And we had a nice week off last week. I was in Texas with Justin as we were at the Texas Dental Association, talking to all kinds of dentists for their 401k. It was a great week with Justin. Good times. Yeah. Well, welcome to Quiver Financial's weekly market update, where we talk about the news that matters most to your investment portfolio and update our clients on the changes that we're making in their portfolios as markets evolve in 2025. We had a little break last week. I was in Texas, got to go to the Waco Surf Pool, which was a great time. Spent a few days with Justin Singletary at the Texas Dental Association's big conference that they do every year. We got a booth. We got to talk to all kinds of dentists about why they need to have 401ks and how to maximize their retirement plan, blah, 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 blah. So now we're back in action this week. And boy, not much happened while we were gone, but some important stuff did. And I'm seeing some things in the markets that are making me go, So let's get into that and see how and what matters to you right now. So this week, we started the week with another Trump bump tariff news. So we ended last week with, okay, Besant and everybody's going to China to get the deal done. And we ended on Sunday and opened up on Monday with a pop higher in the market because they came out and said, we got a 90-day pause. Well, boy, we're going to kick that can down the road. However, in that 90-day pause, the tariffs with China dropped from 145%, which is basically an embargo, down to 30%. And this is on top of previous tariffs. So they're still substantial. So there's still an effect in the market. But we had a relief rally. When we get into the stock section of today's conversation, I'm going to show you the levels I'm watching now that we've gotten above resistance, something I showed you guys a few weeks ago. And more importantly, I'm going to show you what sectors of the market continue to be the strongest within all this volatility. Another big piece of news that I think is relevant to your portfolio this week is Trump and the UAE. So Trump and Saudi, and I know a lot of people are seeing this in the news and probably thinking to themselves, oh my gosh, Trump is making friends with the Saudis and blah, 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 blah. This is the Republicans, okay? This is not just Trump. What you have to remember is that the current Saudi Arabia, in the way that it's set up right now, the current prince got his control in 2016. And just go back and look at the history of when Khashoggi was killed, how he got into control. At the end of the day, it was a coup. It was funded by Carlyle Group, who manages money for the Bush and Cheney family, and then also you have BlackRock and some of the usual suspects. Basically, in 2016, the prince cut a deal with the West that if he would open up Saudi markets to the West, also transition away from oil, which is what he wanted to do anyway. And if you notice, since 2016, Saudi Arabia, Dubai, all these places have really transitioned away from oil into all kinds of a business. And that's also when the Saudi Aramco fund, so the sovereign fund of Saudi, rebranded itself to the private investment fund. And now you'd never know that that was the Saudi fund. So what you're seeing in the news this week with the deals with Saudi have been going on for quite some time. And so that, what that matters to you is, we'll talk about it in the stock section. One of the leading sectors this week, or one of the leading sectors this year in the market, continues to lead with some of this news. And I'm going to show you in the charts some of the opportunities that might be there for you. So this deal with Saudi's been going on for a while. Now, what's relevant to your money in these two things is that when it comes to the tariffs, now we have kind of all the good news priced in. So even though the market's rallied, and that's great, it's kind of gotten everything off of the brink of disaster. Now you got to worry about, now that the good news has been priced in, does this become one of those sell the news things? If you do get some finishing touches on more tariff situations, does the market sell off because it's gotten its boost already? So that's what we're going to watch, and I'm going to show you in the charts what I'm going to watch for next week and the rest of the month. And when it comes to the Saudi situation, it just means that there's going to be a few sectors that benefit from this, and you're already seeing it this week. I'm going to show you those in the charts when we get into equities. Today, we're going to do interest rates, equities, and then gold. So next is, what do I got here? I got to get my eyes, folks. Where's my mouse? Okay, here we go. Next. All right. So the other thing that's really important, I think this is more important than anything else this week, is interest rates. The 10-year Treasury. We've been highlighting it all year, and it's in this row situation, which it's still in the danger zone, and it could be the one fly in the market's ointment, because if the 10-year or interest rates get too high, it could derail things. So next week is going to be really, really, really key in interest rates. So I'm going to show you in the charts the levels and what we're doing with our interest rate sensitive investments, things like traded REITs and treasuries in response to this. Because if you're a 60-40 investor, if you're a more conservative investor, if you're a buy and hold investor, if you're somebody that has a balance between bonds and stocks, the interest rate factor is really, really important. So you're going to want to see this. Stocks. Now, we've moved from oversold to overbought in record time. Good and bad. Hey, better that we're at the levels we're at now than we were in April. So we definitely, the April showers brought some May flowers so far. Now, the next tell I'm going to show you in the charts is what happens next, okay? As far as, do we get a correction in the market? Where does it get support? I'm going to show you all that. And more importantly, I'm going to talk about an approach that I'm taking for our clients on how to still take some opportunity, take some risk in this market in a prudent way. And I'll get into that in a few minutes. Gold started a correction about 2 weeks ago after, everybody was talking about it. So back to the old story, when everybody's talking about it, you're closer to a high than a top than a bottom. So everybody was talking about gold, and now it started a correction. Is that correction over? I'm going to show you in the charts the next moves I'm looking for. Whether you're a trader or an investor in gold, next week could be a big tell. So if you're interested in gold and silver and metals, you're definitely going to want to see what we have there. So let's start off with the 10-year Treasury. What we've been talking about is the thing that's been wagging the dog. And the reason being is there's been certain points over the last few months that if the 10-year Treasury yield gets to a certain level, we see the Trump administration pivot on some of these tariffs. So we can tell by actions that there are some important things happening both in interest rates, which tie into currencies. We started the year in January with a thesis that interest rates were going to stay between a certain range, and I'll show you that here. And this thesis, we start every year with some kind of thesis, and the reason we had this is because if the 10-year Treasury can stay in a range or trend lower, then interest rate sensitive investments, traded REITs, Treasury bonds, things of that nature, they will be accretive to a portfolio as long as rates can stay sideways in a range, like you see here in this chart that goes from 2023 to the beginning of 2025. You can see that the 10-year Treasury has been in this range between 3.5% and call it 5%. So as long as we can stay in that range, then interest rate sensitive investments should do okay. And that's been the case. Since the beginning of the year, traded REITs have performed okay. They paid great income. Treasury bonds, not so much. And here's the reason why. In March, we updated this and said, yes, we're still in this range. You can see throughout the year, we've been staying between, let's call it 3.5 and 5. But we started to identify in March some important thresholds that were early tells. And that's the fact that the 10-year was starting to look like it was going to get stuck in this range between 4 and 4.5%. So basically at the higher end of the range. That does not help confidence in those interest rate sensitive investments, right? Like confidence would be if you could be lower here down in the 3.5 range. So as we got through March and I started to see that, I started to bring it out to everybody's attention because this is part of risk management, is identify the potential risks. And the fact that the 10-year has been kind of sticky at this higher level is a tell that something's going on, and you want to be careful if you have a 60-40 portfolio, if you have a lot of interest rate sensitive investments because you're more conservative, or if you have a 401k that only has stocks and bonds and you've been, having an allocation of a balance. You really want to pay attention to that interest rate factor here, because if 40% of your portfolio or 30% of your portfolio is in interest rate sensitive treasury bonds or any kind of bond that's rate sensitive, and rates move higher, that part of the portfolio is going to move lower. And you don't want to have a situation where you have the stock market falling and interest rates rising like in 2022, because for those types of investors, there's not many places to hide. So then here in April, I pointed out the rut-row moment here, right? Because right there, see that little arrow I just put out there at 4.5%? That's what got Trump to pivot the first time and give a pause on the reciprocal tariffs. What basically happened is Liberation Day happened, and then 2 days later, the 10-year was pushing at 4.5% here. And all of a sudden, the Trump administration pivoted. He even came out and said, well, have you seen interest rates? They were looking like a problem. Now it's a beautiful market. And then 2 weeks later, they came out and said, oh, no, we weren't even looking at interest rates. We're not concerned about that. Well, I think they are, because if you watch the charts and you watch their actions, there's correlation here. So we had pointed out that this little squiggly line at the bottom is what we call relative strength. It's a tell. And when you have a situation where you have a low here and then a lower low, and this relative strength is stair-stepping higher, that's not a great sign, because normally when I see this kind of pattern, it's telling me that this asset's direction, the path of least resistance, is probably higher, not lower. So in March and April, I was saying we need to see what happens. Can we get back below 4.3%? And what really happens to this RSI? Like the next pivot here, what happens to this RSI? Does it go down? Does it go up? So here we are 2 weeks ago, May 2nd. I updated you and I said, where will this pivot be? Right. And it's starting to look like, here. So now this week, and I mentioned 2 weeks ago that interest rates and currencies are probably going to be a much bigger topic, and they are. And just wait for the next couple of weeks, because I think they're going to be really important. Now I've switched up the chart to this week. This is today's chart of the 10-year. We have that resistance at 4.5%. We have support at 4.25. We've been bouncing between there for now 2.5 months. We're at the high end of that range, which is not real comfortable for me. You can see that low there, you have the RSI continuing to stair step higher. And the tell for next week is this right here, is if rates pivot above this week's low, basically today's low, and move above 4.5% next week, or even by the end of today, I have a feeling the market's going to get weird, or at least get a correction from this rally that we've had. So what I'm watching for next week is, does the 10-year continue to pivot higher? Because it looks like it's starting that. Too early to tell. And if it does this RSI do another turn up like this? Because if that's the case, if I see this turn up and we start pushing back towards 4.5 on Monday, Tuesday, Wednesday, I'm going to be really significantly reducing our exposure to those interest rate sensitive names just out of safety. I've already trimmed some of our EPR, our Annaly, our AG&C, because we've made money on them. They paid us well. And I just didn't want to get caught flat-footed, because if this happens, it happens very quickly. So next week will be a very big tell for anybody who's in interest rate sensitive investments on whether you need to run for the hills or you can continue to hold them into the portfolio. What we really want to see is next week we'd love to see Monday, Tuesday, Wednesday, the 10-year break down below 4.4 below 4.3 back towards 4.25. So we'll see. Next week, stay tuned because on Friday, we'll know by then. And I'll be able to tell you if we had to do any actions. This is really, really key. So those are the tells that I'm watching for. So what does this mean to you? If you're a Quiver client, if you're an investor, if you're managing your own retirement accounts or your 401k, what does all that mean in interest rates? Well, it basically means that if the 10-year can stay below 4.25%, our 2025 themes are pretty confident that you can continue to own rate sensitive investments as long as really rates are below 4.5, but below 4.25 would really give you some breathing room. If we get above 4.5% next week and we have a weekly close, a daily close, not so much, but if we get a weekly close, so if we close next week above 4.5%, there's a good chance that people's algorithms will trigger some rebalancing. And so above 4.5% really threatens the theme that you can have interest rate sensitive investments in your portfolio. And if we start to get sustained trade above 4.5%, then if you're a conservative investor, you're going to want to really look at the balance of your portfolio. If you're a 60-40 investor, you're more, if you're more interest rate sensitive, treasury bonds, things of that nature. If your 401k only has stocks and bonds, beware if rates get above 4.5% and call us. And I can tell you what to do within that kind of environment. So that's the bottom line. The 4.5 to 4.25, really, really key. We're doing a special thing, client appreciation. So we've got some friends, actually my son and one of his friends, that have a plumbing and contracting business. And so I decided to do a client appreciation for this year. And any Quiver clients or VIPs, if you have something you need fixed at your house, you have some plumbing that needs to be done, and you'd like some young guys that are clean, kind, and trustworthy, I've got them. I've cut a deal to give you a 30% off discount on anything you need around the house. PCHplumbing.com. Handyman Mike is my son Michael. So it's my form of nepotism. All right, so that's the commercial for you this time around. Let's jump into equities because our 2025 theme for equities is that they were overvalued when we started in January. We wanted and needed to see a correction. We thought it would be led by tech, and that's what we got, right? So, and it turned out to be a much scarier correction than I think we wanted in January. But here we are in May, essentially halfway through the year almost. And our 2025 theme of the market being overvalued and a correction led by tech has happened. We also felt that we would be in an extended period of time of stagflation, and that sectors that perform best during stagflation would be the things that this year would perform best. That is happening. I'm going to show you that in the charts. I'm going to show you, if you want to get in the equity market, an approach that I'm taking for clients. So here's the S&P 500 from 2009 to 2025. We showed this to people in April when we talked about what to watch for in April. The dark green line here is what we call the reversion to the mean. This is the long time support of the market. And that some point, where the way markets work is, you could get a big enough correction to take you all the way back to that mean and still be in a 20-year bull market. And so that's a long ways down, and we don't want to experience that, but it's possible. So what we did is in April, we said, hey, here, this line that started in 2023, this green dotted line is a line of support of the current rally that started in 2023. And that dotted line is basically what I call the bull bear line. Right. So is intermediate support, and that's basically supporting the rally that started in this market in 2023. And trading above the line means you buy the dips. Trading below the line means you sell the rips. So essentially what I did here is I tightened up the chart to be the last 3 years rather than the last 10. And now you only have the dotted line, which is that bull bear line. This is that intermediate trend line that started in 2023. I'm calling it the bull bear line, saying that if we're above that line, the market rally that started in 2023 is still intact. And so the rule book says buy the dips. If you break below that line, which we almost did in April, we kind of whipsawed it, which is normal behavior for a correction. So we whipsawed it. And what we're watching for in the future is if we ever have sustained trade, multiple days, week, 2 weeks below that dotted line, then the bull trend is broken. And at that point, what you do is you sell the rips, not buy the dips. So far, what happened in April is we came to the line and the bulls stick saved this baby. I mean, just right when they needed to. And since then, what we were looking at and said would be the early tell was this red dotted line, which was resistance. And we wanted to see if we could get above resistance and see if the relative strength would start to become more constructive. So here's what's happened since is, 2 weeks ago, May 2nd, we gave you this updated chart. You got the bull bear line. We had this line of resistance that we had just popped over, okay? Just got over that. And our question was 2 weeks ago was, will that resistance now become support? And it did. Here, I'm going to show you this. This is the tell. Well, yes, is the tell is, will we hold support? And will this RSI continue to get stronger? Well, we held support. So there's the bull bear line again. There's our resistance. We came and this is where we were 2 weeks ago, right here. So we took that first Monday, Tuesday of 2 weeks ago, and the market pulled back, and that now did become support. You can see it held it. Very little minor. It probably needs another test. And then the rest of the week, it just kind of meandered sideways. And then on Monday, boom, we got a pop above. And so now have sustained trade above what used to be resistance. So now we've got to consider it support. And basically what's caused it is these two little tariff pauses. So you had the first tariff pause, and then you have the second. Now, what's interesting here that you need to realize that is a word of caution. And the thing that makes me go, is that one, this rally is pretty parabolic. This looks like a short squeeze. It doesn't look like new money coming in. This doesn't look like long-term investors, piling in here, because that usually has a different look. But this does have a lot of short covering. So what we really need to see next is on the next correction, because we're really overbought here. When the RSI starts to get up into that 70, 80 range, then you're overbought. Whereas when it was down here at negative 20 or at 20, that you're oversold. So now we're in a situation that we need the market to work some of this off. And that's going to be the next tell. The next tell will be, do we get a little bit of a correction next week? What I'd love to see would be really a confidence builder would be that the market corrects back down to that 5,600 level and it holds again, because then you'd have two tests. And this second one would be even more significant. And so what I would love to see is can the market correct back down to 5,600, RSI come down, maybe finish dropping at 50 and turn back up. If I start to see those things, then the confidence of the bull market continuing should increase, right? So those are the things that I'm going to watch for. Does that on the next pullback, if we get a pullback, and I think we will, on the next pullback, where does it stop? Where does it find support? And what happens with the relative strength? Because that will tell me whether the rest of 2025 you can stay in the market, or do you have to start to hedge or reduce exposure? So one of the other things I showed you 2 weeks ago is that there was green shoots. And I had showed you that a handful of the MAG 7 had gotten above resistance. And what I wanted to see over the next week or two is, could the rest of the MAG 7 get above resistance? What is resistance? Like, for instance, here on Amazon, it's this little red dotted line. On Google right here. So as of the time that I asked this, there's quite a few of these, basically Apple, Google, Amazon, Tesla, and NVIDIA had not gotten above their resistance. Now they have. Out of all of these, only Apple and Google have not gotten above their resistance. So that's a really good sign. I mean, basically, 5 out of the Mag 7 have gotten above resistance. Now, the tell is, does it stick? And on the next pullback, um, does it create a buying opportunity? So, the other area I want to, because for the Quiver clients, what we did as the market has done this is we have added to our tech holdings. We've added to the ASMLs, the Amazon, the Google, those things. We also, while we were doing that, we looked at the market. And what's amazing is if you look throughout the year, even during the April sell off, the stagflation names like utilities that I just popped up here on the chart continue to have the strongest relative strength. So utilities, you can see, are still trading at the high end of their range over the last year. And even the April sell-off was pretty muted for compared to what happened in tech. So you have a situation where, utilities are still positive for the year and most of tech is still negative. And you have the same thing here when it comes to aerospace and defense. Now, this is aerospace and defense. If you look at this chart, this last run up, a lot of this is that Saudi deal. So in the beginning, I mentioned to you what sector benefited the most. It's aerospace and defense. If you look at a chart of Boeing, you see the same jack up, right? So basically, Boeing got such a big order from the Saudis that it pulled the rest of the aerospace and defense sector up. I tell you right now, as an investor, if you're bullish, like if you're really bullish the market, you don't want utilities in aerospace and defense leading it. That's usually not a sign of a healthy economy. These are the sectors that lead when people are more defensive. And then this last one I'm showing you that's had good relative strength this year and is a stagflation name is the basic materials, or what you would call consumer staples, not basic materials, excuse me, consumer staples. And so consumer staples is all the stuff you need that you just basically can't live without. And so when you have utilities, aerospace and defense, and consumer staples leading the market, that's not what you see typically in a new start to a bull market. Like if you think about in 2023, when this bull market started, the leading sectors were the Mag 7. It was the tech names, the small caps. It was all that stuff started first. And now, as it's matured, you're getting these sectors as your leaders. So that should be a tell. That should tell you, if you're a prudent investor, that you need to tread in equities cautiously because the professionals are. The market's telling you what's leading. So what does this mean to you? Like if you're a Quiver client, if you're an investor managing your own portfolio, well, what can you do with this? Well, what it means is that the market recovery that we've had is really encouraging. It's exactly what we wanted to see. Now on the next correction, we want to see if 5,600 holds because that's important. And in the event that it doesn't, the next tell would be 5,400. A break below 5,400 with an impulsive decline, a 5-wave decline, would really open the door for new lows. Right now, there's no sign of that. The bulls have the ball right now. The bears really, have the work cut out for them if they're going to turn this market back down. So next week will be a really important tell for the overall market of equities as well as interest rates. So it's really, really interesting how they're all correlating as far as their inflection points. I think most likely the rest of 2025, you're probably stuck in a range in the market. So if you're an investor, realize if this market gets stuck in a range, or even if it does have new highs in front of it, how much higher can it go? Because if the market prices are a reflection of earnings are probably not going to get multiple expansion right now in this environment. And earnings were already slowing down going into this quarter. And the last quarter was good, but earnings look at the past. And what we're looking at the future is that earnings should be slower. And I don't think that the current levels of the market price that in. So I wouldn't be shocked to see the stock market kind of stay in a range here that maybe, 56, like 5,900 on the high end, 6,000 down to 54, and you play around there for a few months. So what you can do if you want to be a prudent, take a prudent approach to investing. And one thing that I'm doing for some clients is I'm taking this barbell approach. And the barbell approach is essentially on one side of your investment thesis, you buy the beaten up names, the stuff that's intact, right? Some of the Mag 7, whatever other names you like. Then realize that if the market were to really go back down, those names are probably going to get beat up the most. So buy those in small amounts, be willing to buy more later. And then on the other side of the barbell, put the stagflation names, the names that have had the strongest relative strength so far this year, the utility sector, the consumer staples, the aerospace and set. Aerospace and defense, I wouldn't buy right now. I'd cool your heels on that until let it come down a little bit. But Quiver clients will notice that now in the portfolio, some of our bigger weightings is utilities and consumer goods, in addition to some of the tech names that we have. So you can already see that in the Quiver portfolios, we've already taken this barbell approach, and we started that earlier this year. And then we're building on it as the market has given us opportunities. So that's one way to consider approaching this market and putting some money to work. And hopefully you won't get your ass handed to you if the market does happen to pull back. So I would highly suggest that everybody go back to one of our March events or our March videos, the stagflation playbook, because we gave you each sector, the levels to watch, everything in that. I'll do an update in the next couple of weeks, as it does look like stagflation is going to be the winner for this year, especially if we continue with this tariff stuff. So let's wrap it up with gold and metals. So we have been showing in the beginning of April, when everybody started talking about gold, that it was starting to get, that it was starting to get parabolic, that the relative strength looked like it was topping out. So we started selling our gold. So we went into April and May selling our gold, keeping our silver. And so now in April 25th, at the end of April, when I did our event, What to Watch For in May, we have this small correction that started. I said there's a potential that if that correction stops there, that you could have this like uber trend, parabolic move. And I said, but it's probably less likely. And then I also pointed out that there's this long-term support, what we would call reversion to the mean. So the market, the gold market, could correct all the way back down to that level and still be generally bullish in the long run. So when you're this far away from this big support, I tell people to tread lightly. So what ended up happening since then is 2 weeks ago, I showed you that super uber bull line didn't hold. So it was less likely that you're going to get a parabolic move. The last week, as you can see here, the market did something funny. Is it rallied back and back tested that super uber bullish line. Really, really mean. It probably sucked in a lot of people that thought this was going, parabolic, and then reverses course and does this little undercut. This is really interesting because as that happened, the relative strength dropped. And so next week, what I'm watching for is that, so it's interesting that it broke and came back. So next week, what I'm going to be watching for is, does gold pivot from here? Was this week's lows something that was investable or tradable off of? And what I would want to see is early next week, Monday, Tuesday, I'd like to see if gold can start to move higher. It needs to hold the lows it made this week or today. And while that's happening, does this RSI around this 50 level start to pivot back up? Because if that were to happen, that'd be a pretty positive sign. And if you're a trader or an investor, maybe next week you could take a little bit of a stab. So I'm going to get into that in a second. So silver, we showed you last or 2 weeks ago that it might have better risk return because its corrections have been sideways and it really hasn't gotten parabolic. So I was waiting to see what would happen here on the RSI and if this could continue to trade sideways or with a little tilt up. So here's the chart as of today. Here's that line of support. The next tell, and we have held this week, it did kind of what we wanted it to. And so next week is if gold does pivot higher, does silver go with it? Most likely it would. And does this RSI get above 50? If I saw those things, then I might add to my silver positions. I might try and take a quick stab at a trade in gold if I had the right risk metrics. So this is not trading advice. I'm just telling you that some things I might do if I see the right setup. So what does it mean for you if you're a Quiver client, if you're managing your own portfolio? Well, traders, if you're just getting in and out of gold, like you're just trying to make a quick buck, next week's worth watching because next week you might have a setup where if you know how to trade, if you're a scalper or somebody like that, you might have an interesting setup if it fits your parameters. If you're an investor and you're looking to add to your investment in gold or you're looking to start an investment in gold, and if you're truly patient and you're truly long term and you can truly handle the risk, so if you fit all those matters, then next week, if we do all the things I just told you, if the gold holds this week's lows, starts to pivot higher, RSI moves with it, then you could take a stab at adding to a position or starting a small allocation. Just do it small and be willing to add more if you're too early. Because in investing, being too early is the same as being wrong. I also still think that silver may offer a better risk reward metric. And I do think, if gold does have another pop higher, I think you'll see a short squeeze in silver and could be a little more robust than what you see in gold. So those are my thoughts on that, folks. If all of this was helpful, please give us a like. Please subscribe because I'm going to put out more videos that are shorter and more punchy over time. And next week I'm going to do an update on oil because we haven't talked about it in a while. So I'm going to show you some long-term charts of oil where I think it's going over the next couple of years, not the next couple of weeks. And then with that, we're going to have a conversation around currencies. I'm going to show you some charts of the dollar, how they relate to commodities like oil and gold, and then also talk a little bit about the carry trade and what's happening in markets when things get volatile. So until then, folks, take care of yourself and take better care of others and have a great weekend. And I will see you next week. Bye-bye.